And joining me now to talk more broadly about stocks is Kevin Mahn. He's the president and chief investment officer at Hennion and Walsh. Kevin, great to have you on the show this morning. So much to talk about. So with stocks right near record highs, what's on your radar?
It certainly seems as though we have a Goldilocks type of economy right now, Kristen. Not too hot, not too cold. We learned that private company hiring bounced back in July with a 104,000 job increase, well above the Dow Jones estimate of 64,000 jobs. We learned that wages rose by 4.4% in July, and we've also now seen the first estimate of Q2 GDP come in at 3%, above the 2.4% estimate that we thought going into this first initial reading. So it strikes me that we're in a pretty good place right now.
Yeah.
And that leads us to this afternoon. What will Chair Powell announce, given that the economy isn't pulling back as much as they expected, given that inflation hasn't come roaring back with the threats of these tariffs right now? I believe if in fact they are data dependent, the Fed should have been cutting rates already with the first rate cut coming in the June meeting. Of course, I'm not on the committee. They don't ask for my input. I think they likely pause again today and wait until September for that first rate cut of 2025.
It's interesting, Kevin. Yesterday was the first session, in fact, in 7 that we had seen the S&P 500 not close at a record high.
Yes.
We had a historic V-shaped recovery since the initial downturn in April, but yet we've been trading in very, very small ranges, I would say, the past few weeks or so. What is it going to take to get us out of what has been range-bound yet record-high territory?
Yeah, it's an excellent point. In fact, last week was a golden week for the market where we had all 5 days result in a new record close. But I just go back to where we started this year. Throughout the first 73 trading days, the market was down by over 10%, the 5th worst start in history. But from day 74 through the end of the second quarter, the market was up over 20%. That tells me, as an experienced portfolio manager, that in all likelihood, there's going to be selective growth opportunities over the course of the second half of 2025, as a lot of the potential returns have been pulled forward already. So you have to look to those areas of the market where all of the massive spending is taking place. Where it's AI infrastructure buildouts, aerospace and defense, or even, as we're seeing now, utilities and energy solutions related to both natural gas, remembering that LNG was part of that EU agreement, and also nuclear.
It's interesting, Kevin, highlighting those particular sectors there. I know that in terms of where we go from here, a lot is going to depend, as you mentioned, on rates. We'll see how earnings play out, but spending a factor as well. I do want to talk a bit about banks, because with deregulation, one of President Trump's key promises, I think the expectation on Wall Street was that the banks would be outperforming. What's your view on financials?
I think that's coming. Obviously, there's been a multi-pronged attack, if you will, by the Trump administration to get the U.S. economy revved up again. Deregulation really hasn't been attacked just yet, but that's coming. If, in fact, short-term interest rates do move lower, as we expect they will over the balance of this year into next year, that's to the benefit of banks as well. And I think once you see lower rates and some deregulation, you might see some more M&A activity take place in the financial sector. So look to those financially well-positioned, smaller cap regional banks that have healthy balance sheets and would be attractive to some of those money center banks in terms of a potential acquisition.
How should our viewers be thinking about the municipal bond market? We've been having more conversations about munis over the course of the past few months, I would say, and I'd love to get your take.
Sure, and munis are one of the few asset classes, certainly one of the few fixed income asset classes that really haven't rebounded thus far this year. And there's a reason for that, Kristen, because many investors and many issuers were fearful that the muni tax exemption was going to be taken away as part of that One Big Beautiful Act negotiations. Since that bill has been passed, that muni tax exemption provision has been extended. But what issuers did is that they rushed forward new issuance to get ahead of that possibility. And now over the course of the balance of 2025, issuance should be lower. So anytime there's an asset class where you have less supply and the same, if not increasing demand, prices are going to move higher. So I anticipate a healthy rebound for municipal bonds over the second half of the year, and they're already trading at very attractive tax equivalent yields, especially if you stay in the investment grade space.
Yeah, I do want to talk about volatility too, Kevin, because as we were discussing, we've been kind of range bound, certainly near these record highs the past few weeks or so. How do you see as we head into the fall, some of these more vulnerable months, if you will, certainly August, September, volatility potentially playing out?
Sure. I think there could be more short-term bouts of volatility ahead, whether it's due to what the Federal Reserve does or doesn't do. There's still a big question mark over China. Where do we ultimately end up in terms of trade with China? Remember that those precious metals that they agreed to actually export into the U.S., there was a deadline on that. Let's see if that gets extended. And then, of course, all of the valuations of the market right now are trading a little extended. But if we get a return of volatility, Kristen, that doesn't mean investors should flee to the sidelines and try and time the market. I'll give you one last stat here that I think really hits home with that point. Over the last 20 years, 7 of the 10 best trading days have taken place within 2 weeks of the 10 worst trading days.
Yeah.
Now, I don't know when those 10 worst trading days are going to be, but rest assured, if you're not in the market on 7 of those 10 best trading days, you're likely to miss out on the best returns that the market has to offer. So work with your financial advisor, build diversification in your portfolios, and try and resist the temptations to try and time this market, because it's often an exercise in futility.
All right, Kevin Mahn, President and Chief Investment Officer at Hennion and Walsh, thank you so much for joining us.
My pleasure, Kristen. Take care.